Our previous discussion centered on Satellogic in the satellite imaging sector, but today we are shifting focus entirely. We are analyzing Park Aerospace Corp, a critical supplier of advanced composite materials for jet engines and major programs like the Airbus A320neo family. So the central question, really, stemming from our analysis of Park Aerospace is whether the exceptionally high valuation multiples they command are truly justified. Justified by their rock-solid balance sheet and the recent pretty undeniable surge in defense-related growth, or is the market making a massive sort of speculative bet, paying a premium that ignores the company's, frankly, documented historical struggles with sustained profitability? My argument is that the financial resilience, coupled with these powerful growth catalysts in a specialized niche, absolutely merits this premium.
And I'll be taking the opposing view. While I absolutely concede Park Aerospace operates a financial fortress, that point can't be overstated. We must challenge the sustainability of a valuation that seems fundamentally disconnected from historical and, frankly, current profitability ratios. The market appears to be giving far too much weight to sequential bursts of success without really factoring in the long-term challenges in capital efficiency.
Okay, well, let's start with the foundation then. Park Aerospace operates with a financial structure that's it's genuinely rare in any industrial sector, let alone one as cyclical as aerospace. Absolutely zero debt. Both their debt-to-equity and long-term debt-to-equity ratios are zero. Full stop. This isn't just a healthy balance sheet. It's a massive competitive advantage. Their liquidity metrics are, well, truly extraordinary. A quick ratio of 7.96 and a current ratio of 8.62. They hold an enormous $3.30 in cash per share. This financial defense posture alone, I think, provides a floor to the stock price and merits a substantial premium for safety and resilience. And furthermore, the recent news seems to validate market optimism. Sales year over year, TTM grew a very respectable 16.60%, and their earnings per share saw a significant quarterly acceleration of, 113.52%. This recent momentum, driven by what news reports are calling a defense demand surge, confirms their strategy of focusing on critical, high-margin programs. And analysts are recognizing this, assigning a price target of $26 against the recent trading price near 1971.
Investment value requires more than just safety. It requires efficiency and, returns. The valuation metrics here are just flashing red. Park Aerospace is trading at a PE ratio of 56.83 based on their TTM EPS of just $0.35. That's quite high. We've seen their EPS contract by nearly 11% over the past 3 years and almost 9% over the past 5 years. And when you look at capital efficiency, their return on invested capital, or ROIC, is a mere 6.62%. A TTM profit margin of less than 11% and that low ROIC, that's simply not the profile of a business that should command a PE over 50. The market is extrapolating one strong quarter into a long-term trend, ignoring years of inconsistent capital efficiency.
Okay, but that's a classic value investor critique, one that I think fails when you factor in the strategic nature of this particular business. Let's actually discuss that very point. Capital structure versus efficiency.
I come at the high liquidity and zero debt from a position of, skepticism. That quick ratio of 7.96 means the company has almost 8 times the liquid assets needed to cover its short-term liabilities. Sitting on that enormous pile of cash, coupled with zero debt, when your ROIC, the return you generate on every dollar of capital put to work, is just 6.62%, it suggests the management is being perhaps overly conservative. This cash isn't necessarily a competitive advantage. You could argue it's a drag on performance. It's actively suppressing shareholder returns because it isn't generating meaningful profit against the capital base. They're like a sleeping giant, financially secure, sure, but perhaps inefficiently managed from a returns perspective.
In this highly regulated sector, providing critical composite materials for military programs and major aircraft, a financial fortress isn't inefficient. It is a fundamental competitive moat. That zero debt position ensures maximum survivability through aerospace cycles, and maybe more importantly, provides maximum flexibility to execute major strategic moves. We know they recently received approval for a major production expansion from their largest customer. That cash reserve allows them to fund massive growth instantly without relying on volatile debt markets or diluting shareholders.
Resilience is the investment thesis here, and it's a necessary insurance policy in the aerospace and defense supply chain.
Okay, resilience should absolutely factor into the stock price. I grant you that, but not at any cost. And that brings us right back to the elephant in the room, the valuation disconnect. That 50-plus PE suggests the market expects near-perfect execution going forward.
Right, but that aggressive PE is justified, I believe, by the expectation of rapid expansion of that TTM EPS due to the recent catalysts. This isn't some sleepy industrial stock anymore. It's a niche supplier undergoing a potential transformation, driven by these high-margin defense contracts. We've seen the recent momentum, that 16.60% TTM sales growth and a sharp improvement in operating margins to 15.34%. The high PE is, yes, punishing historical performance, but the market is clearly pricing in the expectation that the recent growth acceleration, particularly that huge 113% quarterly EPS surge, will rapidly inflate those trailing earnings, making the forward PE look much lower. And besides, PE is often a backward-looking metric, best suited for mature, high-efficiency businesses. For a specialized supplier seeing a massive influx of new defense work, maybe the price-to-sales ratio of 6.17 is arguably the more relevant metric.
And 6.17 is, well, quite reasonable for a specialized aerospace niche.
Sales growth over the past 5 years has been negligible, barely reaching 0.66%. And as I mentioned, EPS has consistently contracted over that period. The market is making a huge speculative leap here, betting that a single short-term quarterly spike is the definitive pivot point. It seems to ignore the persistent challenges the company has faced generating high, sustainable returns over the long run. The risk is significant, especially since we don't have specific forward PE or EPS estimates available in the data to truly back up that $26 price target. It feels like a valuation based purely on the hope that management has suddenly solved decades-long efficiency issues.
Well, if the market is confident in the turnaround driven by defense wins, you could argue this stock is clearly undervalued on that price-to-sales basis. But let's look at one key area where management's confidence meets the hard numbers: their dividend policy.
Precisely. Let's discuss the dividend sustainability, because that provides a concrete metric, casting, I think, some doubt on the market's current euphoria. Park Aerospace pays a TTM dividend of $0.5, which gives a respectable yield of 2.54%. However, the TTM payout ratio stands at a severe, seemingly unsustainable 171.64%. Put simply, they are currently paying out nearly $1.72 for every dollar they earn. How long can any company maintain a dividend that is so vastly higher than its current earnings without substantially eroding that famed high cash position? That 171% payout ratio is a flashing red light, isn't it? It indicates they are currently effectively cannibalizing their cash reserves to maintain the payout.
I'd argue that high payout ratio reflects the temporarily depressed nature of the TTM earnings, not systemic recklessness. The dividend commitment is actually potentially a profound indicator of management confidence and stability. Park Aerospace has an established history of commitment to shareholders, having paid over $600 million in cash dividends since the beginning of its 2005 fiscal year. The recent dividend declarations, confirmed for September and June of 2025, signal that management expects significant future cash flow generation or earnings stabilization that will comfortably cover this commitment. In fact, you could argue that maintaining dividend payer status might be viewed by management as strategically more valuable than hoarding every single dollar of that reserve, particularly when future expansion is already secured.
Prioritizing historical commitments over current financial prudence, perhaps artificially supporting the stock price? Let's look at who else has confidence, though. The insiders themselves.
Exactly. Institutional confidence is precisely what supports my perspective. We see institutional ownership at a remarkably high 77.86%. This high concentration suggests that sophisticated, long-term investors have done their intensive due diligence and maintain strong conviction in Park Aerospace's specialized niche strength and future prospects. They're likely seeing through the temporarily challenging TTM earnings figure.
But I would counter that by drawing attention to specific insider trading activity that tells a potentially contradictory story. We've seen several recent instances in early and mid-2025 option exercises, coupled with proposed sales by directors and the CEO. Now, while option exercises are routine, yes, the proposed sales signal that key insiders are actively taking money off the table right near these recent high price levels.
those who presumably know the company best, are selling into this enthusiasm. Doesn't that indicate at least a degree of caution about the sustainability of the current stock price, suggesting perhaps they believe the 19-plus valuation already captures sufficient future growth?
Insider transactions are always complex, often tied to personal liquidity needs or preset plans. True. But the overwhelming institutional conviction, I think, argues for the company's critical long-term strategic position being fundamentally sound.
So the data presents us with this fascinating, almost schizophrenic signal, doesn't it? A financial fortress built on zero debt, absolutely, but one whose valuation seems supported primarily by speculative hope and is contradicted by historical inefficiency and, well, low returns on capital.
My take remains that Park Aerospace is a, let's call it, blue-chip quality asset, trading at a speculative price, yes, but a price that is justified by critical industry specialization, an unparalleled balance sheet, and demonstrable momentum driven by new defense demand and confirmed major customer expansion. Investors are paying for maximum financial safety coupled with what looks like a clear, high-potential pivot in their operating profile.
And I maintain that the price is simply too aggressive for a company with this kind of historical inefficiency track record. A PE of 56 relative to a return on invested capital of 6.62% requires future execution that is, well, virtually flawless. The financial strength is undeniable. I absolutely agree there. But investors must acknowledge they are paying a top-tier price for future growth potential that has yet to be demonstrated consistently over the long term.